All right, y'all. This is the real estate investing war room where we discuss the good, the bad, and the ugly about investing in real estate. There's a lot of things that you can invest in, and I think real estate is one of the best ones out there, but there are definitely lots of risks whenever you invest in anything, especially real estate. So know what you're doing and tune into the show to find out more about how you can avoid any of the pitfalls that plague a lot of the common investors out there that don't know what they're doing. So today, I want to go over a couple of the benefits and risks of different classes of real estate. Typically, if you ask somebody, hey, do you guys invest in real estate? Most common answer is, yeah, I have a rental property or I have a vacation Airbnb that I own. There are lots of different kind of real estate out there that you can invest in. I mean, pretty much every building that you walk by could be a real estate investment, all the way from a little dollhouse for your niece up to the massive skyscrapers downtown. So let's go through each one of these today, and I'm going to talk about my opinions and thoughts about the benefits of what each class has and some of the risks there are. Right now, we're in an interesting economic cycle. There are certain classes that have a stronger opportunity out there, and there's some that have a lot of competition right now, and it can be very difficult. So let's go through each one. I've got a couple of these banners that I'll just kind of put on screen so we can follow along. So first, let's talk about residential real estate. So this is the most common type of real estate that everybody, if you invest in properties and you ask your neighbor if they invest in real estate, they're going to say, yes, I invest in residential. This can include houses, duplexes, 3 and 4 unit properties. Basically, you can own a home down the street, 1 bedroom up to, however many bedroom mansion, if you want, is technically considered residential if a single family can live in that unit and it's less than 5. So 1 to 4 units in a complex. So right now we have seen the biggest demand growth for residential investing, all the way from, your average person listening to a Big Pockets podcast and learning about real estate investing and then buying their first rental property, or doing a house hack and living with roommates and renting out the other rooms and having them help pay down the mortgage over time, all the way up to somebody that might be flipping homes or owning hundreds of rental properties all across the US. So what I'm seeing about the benefits of this is that there's a very low barrier to entry. If you want to move into the house, you can do 0% down mortgages with VA loans and USDA loans up to 3.5% down with FHA. It's pretty abundant. There's a lower barrier entry with some of the costs. You can find, residential homes from $200,000 to $300,000 in parts of the town or some parts of the U.S. Depending on where you are, if you go to like middle of nowhere, you can probably find homes less than 100,000 as well. It just kind of depends. So there's a low barrier to entry. Anybody can get in and do it. And there's relatively low risk in the sense that, like, if you only have one house, you can keep your eye on it. But again, just kind of like everything else, you should be aware of what could cost you money whenever you're getting in and investing. For the most part, these have pretty predictable cash flows. Everyone's going to need a place to live. A house is a great place to live. So if you purchase a house and you put it up on, Zillow or, PadMap or roommates.com or Facebook Marketplace, probably within 1, 2, 3 weeks, as long as you priced it well and have good photos, you'll probably get somebody to move in and start paying you cash. It's pretty easy to run comparables and know how much you think you'll be able to get for rent. And you can say that there will probably be a pretty likely value in the property inherently, just because, houses have value and people need places to live. So as long as your house isn't destroyed and it's livable, it will have a pretty determinable value because of a lot of comparables in the area. Okay, so some of the risks. So right now, residential real estate is really impacted by how interest rates are doing in the market. Because the average person has to be able to buy into these, interest rates went from 3% all the way up to 8% at the height. They're coming down a little bit right now. The Fed has announced they're going to have cuts in the following year in 2024. So let's see kind of what happens there. But there are big sways in the value of homes depending on how the interest rates market is doing. And then we're also going to see a lot of challenges for scaling and growth from the management side. So if you own one house as a rental property, It can be managed just by yourself. It's not a lot of work, but the cost of management compared to what you get for it can be pretty expensive. Typically, some of these single family homes have management fees. I've seen them range from 6% all the way up to 12% management fee. 12% of the rental income. So if you're getting $1,000 a month in rental income and you have to use that to pay your mortgage, taxes, insurance, repairs, and you have to pay management on top of that, that management fee can certainly add up quickly. And there are going to be a lot of months out of a 12-month, let's say you buy a pretty nice home, doesn't need a whole lot of maintenance. You get pretty good tenant screening and you get someone in there that just doesn't make a fuss. They might live there the whole 12 months and have maybe 1-2 maintenance requests total. And you really didn't need a management fee for, because they weren't really doing much to manage it as the rent was coming in. You do need management for if the tenants are late or the tenants stop paying at all, or if there are lots of repairs and maintenance, or it's far away from you and you don't want to drive all the way over there. You don't want to have to deal with finding a handyman every time to come and fix something. So there can be a lot to manage with single families, and the cost of management is high because it's a little ineffective and it's hard to scale because if you have 20 houses that are far apart from each other, it's not very easy to manage lots of them. So that's residential real estate. Lots of benefits to get in there, but again, lots of risks. Just kind of know some of the differences between them. Let's go into some of the other asset classes that a lot of people may be less aware of. So commercial multifamily, this is what we do here at Top Producer Investment Capital. We invest in multifamily real estate, apartment complexes, really any investment that we see that's a good deal. This is where we're most familiar with. So some of the benefits of commercial real estate investing. Management is much easier. If you have 20 units that are located in one building, it's a lot easier to manage than 20 houses separated far apart from each other. And if they're all in one building, you can have some economies of scale by buying 20 units worth of flooring at a discounted price from a wholesale floor installer. You can have one person on site to manage all of the units instead of having to have one person drive to a house to fix it up. You're typically able to have more rolling long-term leases where you would have lots of residents sign a 1-year lease, and typically every month you'll have a few people come up for renewal, but it's more predictable when you will have high occupancy, when you will have vacancy, and you have a more steady stream of income that's more predictable. Whereas with a house residential, if that person moves out, your income goes from 100% down to zero right away. And then you're also diversified because you can have lots of different tenants paying you money instead of just one person that you're really relying on. Okay, so some of the risks, obviously similar to residential real estate, multifamily is very driven by the interest rate environment. Values went way up when interest rates went down to 3%, and now multifamily values are coming down across the country as interest rates are high. But similarly, when interest rates normalize and come back down, there could very quickly be a uptick in the value of commercial real estate as well. Some of the other risks are, these are longer to turn around. With a house, if you buy a house, you can get some contractors in there and renovate a whole house between 2 to 6 months, depending on how big and complex it is. With an apartment complex, it typically will take about 12 to 18 months, on most properties if you're going efficiently on renovations. If you have a vacant house, you put up a lease and you adjust the price until it's right and you get one person to move in, all of a sudden you're fully occupied. Whereas with an apartment complex, if you've got 50 units and only 20 of them are rented and 30 are sitting vacant, it takes a lot of work to get those 30 units all rented. And chances are, if you try to get them all rented at the highest possible price, they're going to get rented more slowly. So oftentimes you have to lower your market rent if you want to get rented more quickly just to get scaled up. And then eventually, once you have higher occupancy, then you can have your rents be more competitive and be higher, but you will have locked in 12-month leases with lots of other residents at lower than market rent. And then the other thing too is you're also subject to a lot of disruption from whatever comes in the neighborhood. So let's say you have a property and the city rezones next to you to say that, now there's a chemical waste plant next to you, where it was a vacant lot before. That's uncommon that it would have that big of a change, but an entire neighborhood can change pretty quickly if a building, typically multifamily, are on these more, commercial or different tracts of properties where they're bigger, and one big bad project can really ruin an entire neighborhood pretty quickly, and it takes a lot of work to turn that around. Whereas houses, if something isn't going so well, you can make your house look pretty good, or you can sell that house and get into another one. Whereas with commercial, because these are bigger, slower moving, it's harder to change an entire neighborhood, and oftentimes, there's things in the area that can affect all of your property at once instead of just with one house. Okay, so let's go on to what else I'm seeing out there with industrial real estate. So this is something that really has my eye right now, and this is where I'd like to spend a lot of attention during this war room. So the reason it has my eye is because, unlike residential and commercial real estate, you don't have as many things that could go wrong. You're basically building, 5,000 square feet of a shell of a building that's got, walls, a roof, and then a garage and a floor. You might have, one office and one toilet in that whole thing. A tenant will sign a 5-year lease instead of a 1-year lease, so they're locked in for a long time. Typically, industrial real estate is triple net, meaning that the tenant that signs the lease is going to pay for the rent, plus they're going to pay for the variability of the property taxes, the insurance, and any repairs and maintenance on their unit, so that the landlord doesn't actually do those repairs. So it's less variable risk to the owner of the property and the landlord, because almost every variable is taken away. The only variable is if you have it rented or not. There are some common area maintenances that you might have to uphold, but a lot of the risks are out of the way. And then typically you will have less impact from economic cycles, because these are built with higher cap rates. Typically they're less variable based on how interest rates are doing. Obviously that does make a difference, but because these typically trade on higher cap rates, interest rates have less of an effect on these as they would with residential and commercial. Typically these aren't leveraged as much with as much debt or a loan as residential or commercial properties, and so because of that, they're less volatile as well. So the thing that I really find interesting about industrial warehouses is just because, you build it or you buy it, and then you rent it out, and then because it's triple net, your job is pretty much done for 5 years, as long as the business that moved in is stable. And typically industrial warehouses can be, Amazon resellers. It could be your local plumber or your local landscape company that needs a place to store all of their materials or have a home base of operations. It could be somebody that is a, discount floor installer, and they just need a warehouse to hold all of their stuff. It's kind of a couple of different of those trade jobs typically use this industrial warehouse space just to store their materials or have a home base of operations that they can use coming in and out. And then, yeah, I'd say there's just a lot less to worry about. And they've got my eye because, I'd had some of our partners bring up that the dollar per square foot to rent these out is not that much less than the dollar per square foot that somebody would pay as a tenant to rent an apartment. So for instance, if somebody wanted to rent an 800 square foot apartment, they may pay $800 per month in some cities. So like about $1 per square foot. You might see something like $1 per square foot for industrial warehouse as well, where if somebody has 2,000 square foot of warehouse space, they might pay you $2,000 a month. And you've got a lot longer lease. And as far as repairs, you're not going to have, or at least you're way less likely to have broken toilets coming up. You might have, less worry about if the heater and cooler is working, because, the people that are in there aren't going to be using it as heavily. They're typically going to turn off the utilities at night. They're typically going to lock everything up. So they're only getting, business hours of use. They're not getting 24 hours of use. And you're typically getting, professional clients that own businesses that rent these things out. So they take a little bit better care of them than the average person who lives in a house who, if they make it their home and they don't have a high style of living, it's easy to trash a property. Okay, so what are some of the risks about investing in industrial real estate? So these can be dependent on the area quite a bit. If, unlike a house, obviously location really matters, but you can buy a house most places and get it rented out with a tenant. With industrial, if you get a bad area that businesses just don't have easy access to, like it's far away from the highways, or it's difficult for like an 18-wheeler to get there, or just something about it makes it difficult to access, you will have nobody going in and moving there. You can also have other regulations. So like if the city comes in and has certain zoning that changes, or they have new laws that are passed that can change what's allowed in the area as far as who your neighbors are, that could really increase or decrease demand in the area very quickly, and then stuck with this building. And then let's see, the other thing that I would say with industrial real estate is that there's I would say the demand can fluctuate. So like right now there's just kind of a low supply of it, so it's not as much a risk right now. But depending on what happens in the future, if there's more of a move to just working from home and not needing any of these warehouses, the demand could fall more sharply than residential, because everybody will need a place to live almost regardless. Whereas there could be some changes in the industry that there's less of a need for warehouse space. But as far as risk go, I think that's less of a risk than these other classes I'm going to talk about here in just a second. Okay, so next let's talk about retail real estate. This is basically just a building where a storefront like a McDonald's or an Adidas or a Nike, or a Chipotle can rent out and set up shop and provide some service to the average consumer. The difference between retail and industrial is that industrial is usually business to business. It's usually professionals that won't ever be customer facing, that might just need delivery or in-house stuff to store products. Whereas retail is going to be customer facing, have nice design, they're going to have good layouts, and they're going to want to be bright and engaging to customers that come by. So similarly with retail and industrial, these are going to be triple net. So as far as the benefits, once you sign a lease, you will have less variability as a landlord, because the tenant is going to pay for the taxes, insurance, and maintenance on the property over time. So you won't have those risks. Typically, you sign longer term leases. 3, 5, 7, and 10-year leases are common, and even have built-in rent increases over time, so that you will increase your income as inflation goes up over time. You also have the potential for some value add. That's the nice thing about retail as compared to industrial. Industrial, if you buy it, it's only a building shell. So there's not a whole lot of improvements that you can really do to add value to it. Really, the only thing you can do is build the thing. And once it's built, make sure it doesn't fall over or get destroyed. At least on the retail side, if there's a retail shopping center, like it can be like a C-class area that looks really run down. It has a bad parking lot. It's grungy, it's grimy, it's dirty. And there are a lot of detractors from the common customer that might come there. Less of a concern for industrial, because if you're just a business, they really don't care as much about how the aesthetics of the outside looks. As long as it functions, hold their stuff, they can work out of it. That's what's more important than how it looks. Retail, you want a good customer experience. So that could be one of the risks of retail is you are subject to how the area looks, and you do have to keep up the exterior appearance. That can also be a benefit of retail, is the ability for value add. You can buy something that looks bad, put some CapEx into it, turn it around, make it look better. And then the other thing is you can have diversification. So you can have lots of different types of tenants. You might have Walmart as your main tenant, or your flagship tenant, as they're often called. And then you'll typically see about, 5 to 10 other stores surrounding it, like a Leslie's Pool Supplies, maybe, Mexican restaurant in there. Maybe you'll have a Hobby Lobby or, like a bookstore or like a CPA alongside this flagship Walmart tenant. And that flagship tenant will drive the other one. The other ones to rent from you more easily. However, that can be a risk in that if your flagship tenant, like your Walmart or your Hobby Lobby or your Target, moves, they don't want that space anymore for some reason at the end of their 5-year lease. It is really hard to keep all the other smaller tenants around if there's not that main big tenant driving people over there, because it's less likely that someone's going to go and visit only a small shop if there's not a huge Target right next to it that really drew people in to start. Okay. The other thing too is with retail, Amazon is a big competitor. Almost everything is going to online shopping these days with Shopify, Etsy, Amazon, eBay, and a lot of these stores where you can just buy everything from home. People just don't, if it's a good that they have an idea of what they want and they just don't want to go out there and get it, and it gets shipped to them in one day and they don't have to pay extra for shipping, it's built into the cost, obviously elsewhere, but it doesn't seem like it's a cost. That's the way they do it. I know I'm guilty. I don't do a lot of shopping except for products that I think are valuable enough that I want the quality. So I want to go over there and feel how it is, or I want to experience what it's like when I'm shopping. Sometimes it's fun to enjoy shopping, but it is a risk where more businesses are going online. So retail is in a bit of flux. That is a main risk where the future volatility is pretty high. We don't really know where it's going to go. Certain retail shops will always be there. Like you'll always have a need to, trying to think, you'll always have to like go to the doctor in person, like there's teledoc that's coming on, but if you do need like operations or something like that, it's one of these other categories. It's not necessarily retail. So I'm trying to think there are some out there that are always going to be in existence, but just less of a demand for retail real estate over time. Okay. Next, let's talk about hospitality real estate. And this is going to be your hotels, your motels, your Airbnbs, your short-term rental stays, just places where somebody can rent, for one night at a time, up to a month at a time. So this would be different than like long-term rentals if you're renting for 6 months or longer. Hospitality has a lot of benefits because there's a much higher potential for income. If you rent something out for $100 a night, that means that you could rent it out every single night and you could make $3,000 that month on a property that if it was rented to a long-term tenant, would only make sense to rent it out for $1,000 a month. So there's a lot more potential for the higher income. However, on the flip side, there's also higher volatility and higher swings. I noticed with our short-term rental communities and obviously all across the nation, they're very seasonal. During the high season, you might be booked every single day. And during the low season, you might only be booked, 10, 20, 30% of the time. So seasonality really affect things. You also have a lot higher risk because you don't really get a chance to vet who your customers are. If someone signs a 6-month lease, you can verify their credit. You can look at their income and qualify them to be reliable to pay over time. But with short-term stays, you really don't have the time or resources to do all of that. So you're pretty much just building in the cost of these nightly stays and hoping that they don't destroy the place. And, you keep a credit card on file and you can have insurance and all this, but you're going to have a lot higher wear and tear and drag on the property. And you don't know who's coming in and out of your building all the time because you don't really screen them. And there's just less of a way to get back if you have damages done to your property. Okay. But as far as benefits go, there's a lot higher potential for value add here as well. You can take a really rundown property and improve it, run it right, and have it make a lot more money. And let me see. Yeah, I would say that's the biggest one, is just the potential for higher income. But on the flip side, the risks are these are far higher management intensive. You have to have a staff that is there to answer questions on pretty much a daily basis. You have to have cleaners going in and turning the units every time somebody checks out, which could be every day. You need a lot of ability to wash towels and linens and get a laundry service going. And if you're doing, 30 hotel units, you got to have a staff that can clean all 30 units in a day during that checkout window from 11 a.m. to 3 or 4 p.m. And, everyone always wants a late checkout and an early check-in. So Accommodating that puts us a lot of strain on management. The other thing too, it's very risky because global events can really affect things in transportation wise. So like if there's a big event in your city that could draw people in and that can be a good boom for you. But obviously COVID really put a damper on all of the travel that was going on. There could be, a heat wave that puts a damper on a lot of, travel. People just want to stay home. There could be a recession in the economy. Everyone tightens their wallets. Typically, travel and leisure and luxury is the first thing that goes out the window if people are tightening their belts and just kind of staying home. And then you're going to have a lot higher costs for maintenance. So not only is your management more intensive, but you're going to have more repairs and you're going to have more expenses for updates and cleanings and replacing all of the soaps, and you have to pay the utilities and you have to pay the Wi-Fi and you have to pay for all these things to be on and ready, whether guests are using it or not. And you don't have any predictability of if you're going to be rented next week or not, because somebody could cancel their booking with you, and maybe you can keep a deposit, but there's much higher chance you could just have all your income disappear overnight. Whereas at least with long-term real estate, all these other long-term leases, you're very predictable what your future is going to look like. Okay, let's talk about healthcare real estate. Now, to be fair, I know less about this category than all the other ones so far, but basically this is if you were to buy a medical facility and set it up and allow your dentists, private practices, ENT, surgery, whatever kind of doctor facility, you can have it built specially for that, and you can have specialty chairs and equipment and higher light visibility or higher standards for cleanliness installed, and then really market it to doctors. So some of the benefits about having healthcare is that just like everybody needs a place to live, likely everyone's always going to be sick and hurt and need healthcare at some point. If someone has a broken knee, you can't really fix that online. You have to go in person somewhere to get that fixed. So there's going to be more of a demand for that than a lot of these other classes. You're also going to be able to sign longer term leases with healthcare providers like doctors. These are typically triple net and also on 5-year long leases or longer. So you have a lot of stability and a lot of predictable income that comes in over time. They're also an essential service. And so there a lot of the variability that happens in these other sectors, you're not going to have with medical. You can count on everybody being sick at some point, and there always being a demand for healthcare, no matter what's going on in the world. So some of the risks that happen is that the government plays a big role here as far as what regulations they impose, if they're having Medicare, Medicaid, insurance, what policies they're passing, what kind of premiums are going on. A lot of doctors' industry is almost out of their hands. They're good at being doctors, but a lot of how much they can charge and how much profit they can make is really influenced by the government. So there's a big piece that gets played into it there. And then there's other healthcare, market dynamics that can kind of happen as far as, a new technology or a new pill that could emerge and maybe make a previous practice either obsolete or very less necessary because of this new technological breakthrough in medicine. So there could be a little bit of a risk in that. And like, for instance, let's say you have a tooth whitening facility and it's been rented out for a while, but this new technology comes in, you can digitally clean not digitally, but you can clean your teeth, at home extremely easily. And it's much more cheap to do so at home because of this new technology that comes out. Well, a teeth whitening dentist may not have a need for their industry anymore and may up and leave. And then you'll have to redo the property to turn it into some other kind of healthcare facility. Okay. I would say for healthcare facilities, these are really good. They're less affected by interest rates than some of these others because they're less leveraged. But yeah, you're more likely to have just very stable, predictable income. But typically you would want to understand a little bit about healthcare and a little bit about dynamics and what a doctor is going to want inside of the building. It's not as plug and play. There's a lot of specialties. So if you buy one of these facilities, you're going to have it decked out specifically for a certain practice. Like a general practitioner is going to be different than an ENT. It's going to be different than a dentist. It's going to be different than a chiropractor. So each one of these specialties is going to need a different office layout. So you're going to have to set it up that way, or whoever comes in is going to have to pay to have it set it up their way and taken down afterwards. Okay. Let's talk about mixed use development. Now, this is something that I get very excited about because I think that they're very cool. And I think that there's a lot of synergy in ways that they can benefit each other. So mixed use development is basically when you have residential multifamily units on top of retail on bottom, or some mix of all of these different classes. So you can have your restaurants, your coffee shops, your bars, your Lululemon on the bottom floor. And then above that, floors 2 through 6, you're going to have your apartments for living in. And typically these are in, very urban, densely populated downtown areas. These are typically your class A, not necessarily high rise. They can be high rise, but typically your better apartments that command the highest rent in the area because they have the most amenities present. Because if you can walk downstairs and get a little bit of everything that you need and then walk upstairs, that's easier than having to drive down the street and get it. And typically you're going to find people that, because it's such a nice thing to have, you're going to attract better quality tenants and you can command higher quality rents. So what I would say is some of the benefits about this is because you're going to have diversification. You're going to have residents paying you rent for living there. You're going to have rental income from the retail shops that are underneath you. And if the retail shops are not doing so well, at least you've got the people living there paying income, and kind of vice versa. If for some reason it's hard to get people to move in there and rents are low or vacancy is spiking on the residential side, you can still have foot traffic coming in to check out the retail shops down below. And it's very easy to advertise because as people are checking out the retail shops, you can say, hey, by the way, while you're here, did you know you can live here? Come upstairs and we'll give you a tour. There's a lot of built-in marketing and you have a lot of diversification there. You can also attract a variety of people that want to live there and a variety of customers depending on who the retail shops that you have underneath you are. So if you've got like a waxing studio and an ice cream parlor and, like a nail salon or a gift shop, you're going to attract a lot more chic female crowds. Whereas if you have maybe like a gym and, you can have like an auto parts shop and you can have, some more masculine things, you can have that kind of vibe to it. So you can really set the characteristics of the living space by the retail shop. You can almost create your whole neighborhood ecosystem all at once. If all you do is own a house or an apartment complex, it's very difficult to change the community. In this, you have the entire community. It doesn't really matter what your neighbors are doing on either side. I mean, obviously it does, but even if they're not doing things that you think are ideal, you can shape how you want your community to be. And you can make it so that residents really only stay with a little bubble and they don't go outside unless they're getting in the cars and driving somewhere else anyways. Okay, so some of the risks, obviously it's difficult to manage two different types of things. Leasing out retail spaces is different than leasing out long-term places to live. So you almost have to have two marketing funnels to attract two different types of clientele. And it's also different managing each one of these. And if you have a lot of vacancy on one side, the other side could lose interest. Like if there's not a lot of people living there, the shops underneath aren't going to find a benefit in having a store where nobody is, and kind of vice versa. If you have people living there, but no retail shops, then what's the benefit of paying extra rent to live in a place like that? So even though it can benefit and help syndicate advertise when things are going well, it can also do the reverse very quickly. These are very sensitive to market dynamics. Anything that changes with interest rates or growth in a community area or trends that might change can very much affect how popular an area is. If you have this building built because they're typically A-class, top of the market, if it becomes the not so trendy part of town and everybody wants to go to the newer, cooler, hipper part of town on the other side, there's not a lot that you can do if the city is pushing urban growth and development that way. You're kind of just stuck with this really expensive building that you built, and it's going to quickly deteriorate and fade if it's not the cool part of town anymore. Okay. And of course, if you do end up owning one of these and deciding to sell it, having a buyer that'll come in and being able to handle both of these types of management, because you're having to do lots of different things, it can be difficult to find a buyer to take that on. And it's very operationally difficult, kind of similar to the hospitality. Like, instead of just being able to sell it to anybody that you want, you have to find somebody that can come in and operationally handle the difficulty of running something so active. It's definitely not a passive source of income at that point. Okay. Let's also talk about real estate investment trusts. Now, this is about as passive as you can get, similar to being able to buy stocks in the stock market with Apple and Google and Berkshire Hathaway. You can buy real estate investment trusts. These are large corporations that own a lot of different types of real estate all across the US. They are typically giant companies with huge portfolios and billions of dollars of assets under management. So you're very diversified when you come in. You can be very liquid. You can buy them just like a stock. You can buy them one day and sell them the next day. You typically get predictable cash flow. These typically pay out dividends, anywhere from 7 to 10%. And the value of the REITs can also increase some over time, but they're typically a dividend-heavy stock that you can own because they pay out cash flow. I will say it's nice as a diversification play because if you already own stocks and you're familiar with that environment and you want to keep your money liquid, but you just don't want everything to be in companies, real estate investment trusts are a great way to stay diversified and be in real estate without having to do any kind of management, any kind of oversight, but still being invested in that sector. Typically, these are handled by professional companies that have these huge portfolios. So it's not like you're having to either do it yourself or having to trust somebody that's just getting up and running. You're typically working with huge industry professionals. And then obviously being very liquid is a benefit because you can take your money in and out as much and as often as you want. You're not locked into a house that you have to put on the market that might sit for 30, 60, 90 days, or an apartment complex that might sit for 6 months, or one of these warehouses or hospitality centers that might sit for 6 months to a year until you find the right buyer to come in. That's also one of the other things I didn't really mention about retail and industrial and a lot of these other non-residential forms of investment. While you do have 5-year leases, typically these can sit vacant for 6 to 12 months before you find the appropriate tenant to come in and rent from you. Okay, so back to real estate investment trusts. I will say because they are such large companies, they have a lot of overhead. They have large offices. They have a lot of staff. They have a lot of regulations and the SEC that they have to deal with, and all that costs money. So because of that overhead, it really eats into a lot of the profits that they can have. And also having to be liquid, even though the assets that they own are very much not liquid, they have a lot of money in reserves to allow people to come in and out of these real estate investment trusts. So those two factors really dilute the returns that you can get. So on real estate investment trusts, you are exposed to the real estate sector and you can benefit by being diversified with them. But on the riskier side, you're not going to make as much money doing it this way as if you were to do it yourself or privately invest in one of these other classes of real estate with an operator who is effective at doing it actively. Okay. And just like everything that we've mentioned before, interest rates and popularity do play a big part in this. So as interest rates go up and down, depending on what sector the real estate investment trust invests in, the volatility and the marketability can be very affected in this. So there are a couple classes that we didn't really mention. These are just the bigger ones that we have talked about here. So I'm curious to hear what you guys think about all of these. I'll go in and say as far as what I'm thinking about for the future, I think that this is what I was kind of talking about last week, that residential housing and even multifamily housing now has just gotten very popular. There are a lot of gurus out there who are making it very popular to invest in real estate, and I'm happy that they're spreading good knowledge about how you can invest in real estate, and it can help make millionaires out of many people, including the average person, much more easily than if they were to try to start their own business or do all these other ways that they could potentially invest their money in something that is you're more difficult to understand. So real estate is a great asset class, but residential and commercial multifamily are becoming just crowded and more difficult and expensive, and they don't really pay out as much cash on cash as they used to. So it's becoming difficult to make it a profitable investment, at least at the purchase prices that you're getting these days. So on the flip side, a lot of these other types of real estate can be more beneficial if you know what you're doing. Obviously, there are more inherent risks because all of these, other than where somebody is living, you will have a lot higher vacancy, and but you will typically have a lot longer time of someone owning that real estate, or sorry, you will have a lot longer time of tenants being in there, and so they're less volatile. There's less fluctuations in the market typically, and you have a lot less competition. If you ask the average person, they're probably aware of at least how to invest in real estate, and they either probably do it themselves or they know somebody that owns a rental house that they rent out. Very rarely will you talk to somebody that owns an industrial warehouse or a medical practice or a healthcare facility that they rent out to doctors, unless you're talking to some specific real estate professionals. So just by that nature, because there's not so much a barrier to entry, but just a larger knowledge barrier to entry, you're going to have a lot less competition. And when there's less competition, typically you're going to have higher rates of return because you're more often going to be able to find good deals. You're going to find operators who are running poorly, and the market's not just going to bail them out. So there's just a lot of opportunity to find good deals and manage them in a way that can be very profitable over time. So out of this whole list that we talked about, as I mentioned earlier, industrial real estate really has my attention because of the growth of, sites like Amazon, because of the rise with people starting their own businesses now after COVID, and how low average wages are in America compared to how high everything else is in America, how easy education has been with the right mentality that if you just log into YouTube or you get on Google, you can teach yourself pretty much anything. And the you can't learn from those sites, you can find communities that will teach this to you, and you can find mentors. It's so much easier to start your own business now. You've got sites like Canva where you can create your own graphics. Obviously, we're using StreamYard here where we can create content to push out to the people. You've got CRMs at a affordable price. All of these products that used to require specialized knowledge are becoming easier and easier to access at lower and lower prices. So almost anyone can start their own business for next to nothing and run it and start making money for themselves instead of working as an employee for other people. So if more and more people are starting their own businesses, they're eventually to the point where they need to house their materials that they're shipping out, or do distribution for their supplies, or have centers for where they operate out of. And so because of that, I just see industrial warehouse space continuing to grow. I'm here in Austin, Texas. A lot of businesses are locating to Austin, Texas. They're all going to need those. I want to say, I was looking at a recent report. I think 3% of industrial warehouses are sitting vacant compared to anywhere between 7 to 12% of houses and apartments are sitting vacant right now, in Texas. And so that that's a big cursor right there. That unless your building is dilapidated or fallen down or in a bad part of town, if you slap a for rent sign on there and you let your local broker know that, hey, this place is for rent, they'll probably bring you some buyers if you've got it at a reasonable price. So that's where a lot of my attention is going to be in this next year. To hear where you guys are seeing opportunity out there in the market. So go ahead and comment on here. Again, we do these real estate war rooms Wednesdays at 6 p.m. We'll be conducting interviews with other real estate specialists over time. If you have anybody that you want to have on the stream or the podcast, or you want to come on yourself, or you have some topics that you'd like us to discover, feel free to add a comment, send me a message, and let's hear from you. So thanks so much, y'all. Real Estate War Room. We'll see you next Wednesday at 6 p.m.